Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow, Chicagoland Retirement with Chicagoland's CFP certified financial planner, Tim Stearns, here with us to help guide us through the complex financial world. Tim, always a pleasure. Welcome back.
Peter, thanks for having me.
Tim, we are glad you are here because we talk about the financial world being complex more than ever, I think. And so much of our financial confidence, so much of our confidence in life is built around our understanding and our handling of our money and our finances. And Tim, sometimes we feel like we're on one side of things and doing well and handling our finances with control. And then sometimes we get caught in the whirlwind, and maybe for some people more than others, it feels like we're always behind and the money is running us. And I think the difference lies in having a plan and working that plan and having some financial discipline.
Well, I think it's a two-sided equation. You know, some people have great control over their money, and then others might feel at the time that they are controlled by the money. That being said, I think that in retirement, when you're not earning money, that would be a really awful feeling, and that's why we're a big advocate of actually making, a protect and grow plan that would actually, make sure that you aren't being controlled by the money. In fact, that you're just, having fun and, as they say in Chicagoland, have the life of Riley, where your bills are getting paid, and you're not worried about the market per se. That those are the things that are important. And, it's been proven if you have a strategy, you're happier in retirement.
Well, if you would like to get that Protect and Grow plan, pick up the phone, give a call, 800-640-2256, 800-640-2256, or click the link anywhere around the video. If you're watching the podcast, Tim does make his time available to you, always makes it convenient, easy to get in touch. No cost, no obligation to have that plan, by the way. So really no downside for being in touch. A snapshot of where you are currently, discussion and writing down detailing of goals so you can turn those into realities into the future, and then the step-by-step instructions on how to do it. If you'd like to get that Protect and Grow plan, pick up the phone, give a call, 800-640-2256. That's 800-640-2256. And whether we're kind of struggling with debt or building wealth, whether we're being intentional with our money and working a plan, or perhaps being frivolous, operating without a true spending plan, again, we'll talk about all of those factors on today's program, but the most important part is that you get that plan to refer back to check up on progress, make sure you have met goals and benchmarks along the way, and then to review and update, because we know that life will change. But Tim, one of the big things that we almost realize when we talk about this financial confidence and the process of building it is that the foundation of that has first and foremost always come from a paycheck.
Yep. I agree. A paycheck is exactly what people are looking for in retirement. And again, we always have people come to us and ask us, I have a lump sum of X amount. Is that enough? Well, have you done a plan? Well, on the back of an envelope type of stuff. So what we do, and we do income allocation, is that we make sure that they do have a paycheck. The foundation of all the further financial success and progress is having a reliable paycheck that's coming in. I know that's peace of mind, and, people, that's what they want, and living, like, oh, I hope I got enough, I hope I have, whatever it takes to get through a 30+ year retirement. That's a real thing nowadays.
Tim, we trade our time for money during our working career. So by de facto, as a result, you would think that the more important of the two is the money, when in fact it's not. It's the time that is so important. And we eventually try to work just enough so that we can build up the nest egg or the assets or the income stream so that we no longer have to make that trade. But here's the rub. Here's the missing part, I think, is that a lot of people continue the same investment plan with the paycheck as they do once they leave the paycheck behind. And we've got completely different needs from our money. So having a spending plan in retirement is really the way that we replace that paycheck with confidence.
Well, you know, most of these people nowadays that are getting ready to retire are baby boomers. And, they were introduced to a 401k many years ago when they were young. And now, whatever they retire with on that day, it's a finite amount. You don't go in the backyard and pick it off a tree, right? And they don't, in a lot of cases, they don't have pensions. So whatever they're getting from Social Security and whatever they've saved over their lifetime, that's kind of the end of the show. So you need to make sure that that money lasts.
Tim, having that lump sum, looking at that, that could give us a sense of confidence, but it can quickly be eroded once we start withdrawing from it and spending it down. So can you quickly walk us? I know we've gone in depth on this on previous editions of the program, but the process of how we create and craft the plan to transition and translate that lump sum that we've saved that gave us the feeling that, yes, we're ready to retire. How do we actually produce from it what we need in retirement, which is income to live off of?
We literally tell people, I want to know what goes out the door and what's coming in the door. And that's how we get it done, and it's called budgeting. A lot of people, a lot of Americans don't do that. Or if they do, what they did during, pre-retirement is a whole different story than what they're going to be doing during retirement. Our bill's going to change drastically, probably not, but if they do, we just had a client the other day who bought a place in Florida, his dream home. We had to adapt to that. Life is dynamic, so your spending plan should be too, within reason. If anything, we try to underpromise, overperform.
Well, I know that is a process that you talked about in depth when we discussed income allocation, and you've got a whole book that basically walks step by step through that process and shows people the risks that you face with the old investment plan versus how you can address those with having a specific spending plan and an income allocation.
Well, I want to ask anyone out there that if they have over $500,000 worth of money in their IRAs or assets, however you want to look at it, and they want to get the book into their hands, we'll do that for the first 10 callers. And I'm also going to say to those people, how'd you feel in March when your market went down 22.3%? I know that was not a very good feeling for a lot of Americans. So that's something else that I want to keep in the back of your mind. Or if you want to go one step further, how were you feeling in 2008? How many times have you sat down with someone, Peter, and they said, oh, I'm never going to do that again? And then you look at their portfolio and they're doing the same thing. It's called asset allocation. And it's failed over 5 times over the past 21 years. Why would you stay with something that did that? So there's a different way to retire, and that's why we do income allocation.
Well, if you would like a copy of that essential retirement planning resource, the guidebook on how to craft your spending and income plan in retirement, pick up the phone, give Tim Stearns a call. He makes 10 of those available on the program, the first 10 callers with at least 500,000, because that's who these strategies work best for. So if you've saved that for yourself for retirement, give a call now, request your copy of the book, physical copy in your hands, or you can get a digital edition. Either way, Tim will get that. Make sure that you get what you are requesting there, which is income allocation, the guide that talks about how to structure those retirement plans. 800-640-2256. That's 800-640-2256. 800-640-2256. Tim, in today's world, I know another thing, the lump sum means something, but also the credit score means something. And so maybe we don't think about this as part of our financial progress or our plan for retirement, but having some available credit might be something that we need to pay attention to. Having it and using it are kind of two different things, right?
Well, yeah, I mean, you need to, credit's a nice thing as long as you're disciplined about it and you don't let it go haywire, especially when you're in retirement. Spending frivolously is not going to get you anywhere. So you want to make sure that you have a blueprint that is wired that, maybe you do use some credit here and there, but you're paying it back down, so that you're not getting crazy with borrowing money in retirement.
Well, Tim, there are some out there that advocate for having a zero credit score and absolutely no credit. But yet at the same time, I mean, I think it's a good system and good in theory, but those individuals probably could plop down the cash to buy just about anything in the world
Right.
they could ever desire. And if they wanted credit, it probably would be extended to them. And another school of thought is kind of use other people's money, get as much available credit of the right kind of credit as possible, and then use that to build wealth or income for yourself. Maybe neither one of these is always absolutely wrong, but certainly neither of these is always absolutely right either. Balancing the two is kind of
Right.
tricky. And we've got to realize that when we are building wealth, we are ourselves creditors. We are loaning our money out to a bank. When we put it in a savings account or a checking account, they're paying us a pretty pitiful rate of return for that loan, low
Yes.
interest. Um, Annuities and bonds, we are loaning our money out to certain types of institutions or government entities, municipalities. They are in need of capital. We loan it to them if we are savers and investors, and they pay us a return, an interest rate, a yield. So what side of debt we are on really makes a big difference.
I, I would agree with that because you want to make sure that you're on the right side where you're getting paid back, right? But I mean, it does build wealth. A lot of my very successful clients still are carrying mortgages and some debt because they know that the power of leveraging their money into other vehicles, whether it be a business, a rental home, VRBO, Airbnb, etc.
And Tim, as we look at the ways that we can sort of put our assets to work these days, or the way that most Americans end up beginning to just establish themselves, debt is part of that process. And not many people have the money to plop down to buy their first home. So we take out mortgages from banks. Um, we may not realize it on the surface, but our financial system is really built upon debt. And so properly managing that is going to be an important part. Um, I know that it used to be, Tim, a goal for moving into retirement to be completely debt free, to have the house paid off, to have vehicles paid for, to have no medical bills or student loans or any of the like. The kids are up and out. Is that as important today with the very low interest rates that we have?
A lot of my clients are saying that money's free right now. So, if that's a thing, if you can do better than, like the 2.5 to 3% that you're paying on your mortgage, then have at it. I mean, we don't advocate for that ton of that in retirement just because, we want to make sure that we're being able to pay the bills and not living outside of our means, which, a lot of Americans are very good at doing that. You see people running up credit card bills that are just insane, especially in this past year. So those are things that we try to keep an eye on people, make sure that, if they need help with something like that, but we're going to help them with debt management, you know. And again, and I've said this before, thank God we have a CPA on staff that can show us different things, a state attorney that, can help us protect things. These are the things that we cover the full gamut.
But with the low interest rate environment, it's not as damaging as it once
No,
was if we do still have a mortgage on our house.
right.
However, on the other side of that, again, there's two sides. If we are savers and investors, these low interest rates are making it increasingly difficult to find secure and stable ways to generate an income.
Right. And that's where I think an annuity comes into place, better payouts. We have a really good article put out by Dr. David Kelly that talks about how, an insurance company can take on 30 plus year retirement, because of they're working with averages versus if you're the normal investor, that money is yours and it's finite amount. If you run out of it, you're in trouble. So when we're doing income allocation, we make sure that people understand exactly the power that the annuity will bring to you.
Well, again, if you would like a copy of that book, Income Allocation, it's not about a specific type of product. It is rather a strategy, a discussion of
Yes.
risks that you'll face in retirement and how to structure your assets to address them. pick up the phone, give a call, 800-640-2256. That's 800-640-2256, 800-640-2256. So Tim, obviously the low interest rate has come into play in kind of the advice that you are providing and how we have to look to structure assets. Do you find that it's pushed a lot of savers to be investors, or even investors who would have been more conservative to take higher risk than they would have typically been comfortable with?
Well, when we analyze people's accounts, we see a lot more junk bonds in there just to get a yield. And that's obviously an issue. They have never been rated. Are they all going to default? No, I don't think that. But I mean, you're also taking undue risk, versus you have T-bills and treasury bonds and that type of thing that aren't paying worth a darn. And you're kind of working in the middle there. So you got to find a happy medium. But I've noticed a lot of the mutual funds that we look at, people are trying, the money managers are trying to get a yield. And so they're buying not that great of bonds.
How about another aspect? I mean, we're talking about credit and debt. Tim, how much does it worry you when you look at our nation's debt? I mean, I've gone to usdebtclock.org, and it's pretty scary watching those numbers tick
Absolutely.
away. Does that come into play as you are helping individuals kind of navigate this financial world, structure their plans, and control what we can and identify what we can't?
Right. That's an amazing clock, and no one really knows who sponsors it, which I think is interesting. And it moves real fast. So yeah, it is concerning. I'm concerned about inflation being out there. You know, someone's going to have to pay for the stimulus that they just put through, and the first one in the previous year. These are things that are, we're concerned about and we're watching, as again, we said, or as I said, we have a CPA on staff. So making sure that we know exactly what's going on in Washington and that type of thing, because, the Fed controls all right now, it seems. And so we need to be cognizant of what they're up to.
Well, I know that looking at those numbers, I was told once upon a time that spending today and debt today is taxes tomorrow. Yet we've
So true.
remained in a pretty low tax environment. Do we need to pay attention to maybe that logic now more than ever, and look at where we are with our tax rates or tax brackets, our pretty low tax environment, and look at it as an opportunity and plan ahead?
Well, yeah, I mean that's an opportunity for Roth conversions. I don't know about when people are working right now, whether that's a thing that I'd want to be doing. We have to look at the numbers. But once they retire, if they're in a lower tax bracket, if they can fill up under the current tax laws, it's going to sunset in 2025. These are opportunities that are out there.
Well, again, we've got to identify those opportunities where we can to control or at least address what we can. And even if it's not within our control, to take steps to isolate and protect ourselves against it. And that's what the planning process is all about. That's what the Protect and Grow plan helps you to accomplish, identifying those opportunities to be strategic, to be efficient, to leverage your money and your dollars. If you'd like to get that Protect and Grow plan, pick up the phone, give a call. 800-640-2256. That's 800-640-2256. This is a snapshot of your current situation. Where are you now? A discussion of where you want to get to, your goals for the future, and then designed and assisted with a certified financial planner, a qualified, experienced professional, recommendations on how to have your money work to help you achieve and accomplish those goals. Simple to understand language and a timeline of executable action items. This is not 1,000 pages of financial jargon. This is concise and consolidated so that you can understand it and you can act on it. The Protect and Grow plan, and what your specific goals are, those are reflected in the plan. Give a call, 800-640-2256. That's 800-640-2256. Tim, we've done previous shows. In fact, just within the last couple of weeks, ladies and gentlemen, you could probably go back and listen to the archives. But with this discussion of debt, I think it bears repeating. There's sort of three categories, three buckets, we called them, of where we can place money. The American public, by and large, has been taught to save our money in one bucket, the tax deferred bucket. But tax deferral today is future debt and payments to the IRS. So, Tim, do you ever run into anybody that's very rightfully so proud to be debt free, but then they've got a huge debt to the IRS that they've got to pay for in retirement?
Well, when we're teaching our retirement classes, we ask people, what by a show of hands, besides your house, what's your biggest asset? And hands down, it's a 401k that's never been hit by the IRS.
Sure.
So these are things that we take a look at and try to get ahead of for people. Not only that, but as you're pulling down income, it can affect what your Medicare premiums are too, which is a new thing as of the last couple of years.
It's
You know,
means tested. IRMA, I think it's called,
yeah,
right?
it's called Irma, right? Exactly. Most people, and I think a lot of the people that are listening to the show are pretty educated. They don't know about that, or if they do, they don't really follow what the deal is. So what we do is we show people, how to maybe do some Roth conversions so that you're not taking out all taxable money where you're pushing yourself into a higher tax bracket where not only your Social Security is taxed, but also your Medicare premiums go up.
Well, again, these are things that we need to know. We need better education on these facts and factors well ahead of time. And we do know that things change, circumstances change, rules change, laws change. I heard a pretty appropriate little line earlier this week, Tim. It was, when it comes to retirement, the tax code is written in pencil. And it seems like they can change the rules anytime they want, especially when we make that deal to defer and delay paying that tax bill.
Right. Like, and again, it's supposed to sunset in 2025, but under the current Congress, that could change on a dime, real
It could
quick.
be moved forward to where we're paying higher taxes sooner than
Absolutely.
expected, because it's
Right.
already in place that we will be paying higher taxes. It's just a question of when and how much higher.
Right. So that's one thing. And then the other thing we're looking at is that you have, um, you know, they've been talking about having the estate tax come down to like $3 million. And if that happens, back when it sunsetted, it was 40 cents on a dollar. That's pretty pricey,
Yeah.
of all the dollars that you have.
Well,
So,
on money that's already been taxed once or twice. I
right.
mean, Tim, the way that our system works, not only are there three classifications that we can put our money into when we've saved it, but there's actually three different types of income as well. Most of us are in the first category, earned income. It's the one that we've been talking about. We trade our time for money, and that's actually the highest taxed category. You move one step further, and it's where most of us are trying to get to, where assets are generating some amount of income for us, right? Investment income. Few tax advantages there. But we all sort of know in the back of our minds that the ultra wealthy, they're not trying to build up as much in an account as possible. They're trying to actually put their money out there and put it to work. And that passive income that they generate, that's the most tax efficient income that's available.
Right. So there's some different things out there that people can be doing. For example, cash value life insurance is a great example. Not only that, but there's long-term care components in a lot of the products nowadays. And then, of course, there's a tax-free death benefit that is obviously helps everybody out, especially if you have a larger estate and you pass. You don't want to be, you didn't earn all that money over your lifetime to pay an estate tax. That's not a thing.
Well, again, so many things can shift and move and change in the financial world. That's why having that plan in place is vitally important. So you have that sense of confidence and control, but also continuing to review and update the plan on an ongoing basis. And Tim, you talked about that Secure Act that passed at the beginning of last year. Basically, if anybody had a single dollar in a tax deferred account and had plans on when to use it, how to use it, or if they were going to pass it on, those plans now need to be reviewed, revised, revisited, don't they?
Absolutely. We always tell people at least a couple times over a 5-year period, you should be reviewing exactly are there, one of the slides we show people in our classes, do you have a ticking time bomb in your estate, which would be like a 401k, where, nowadays the stretch IRA is gone. So a non-spousal has to drain that down over 10 years. And if you're still in your livelihood of earning money, the last thing you want to do is have more income so you pay more taxes right now.
Yeah, the net effect, Tim, is it's probably increasing the taxability of those retirement accounts, isn't it?
Yes.
Well, that's
Agreed.
again, things that we need to be aware of and plan for and review and revise plans on an ongoing and regular basis. And that's why Tim Stearns offers that Protect and Grow plan. If you would like to get a Protect and Grow plan, the help and assistance of a CFP, a certified financial planner, in putting your plans together, no cost, no obligation. Just call from the show today, 800-640-2256. That's 800-640-2256. Tim, could you highlight for us, what do you feel are maybe the most 2 or 3 most important things that Protect and Grow plan can help a saver or investor address?
Number one, not run out of money. And is it guaranteed? Of course not. If you spend, like we talked about, frivolously, it's not going to work. But if you stay within a budget, you still have your lump sum that you can work with to do the trips that you've always wanted, maybe help the grandkids out with something, college, weddings, that type of thing. But at the end of the day, make for an enjoyable retirement where you're not going to run out of money.
Give you some guidelines to stay between at the very least.
Exactly.
Yeah. Anything else, Tim, that Protect and Grow plan that you feel, most people probably need to have some help and assistance in addressing?
Sure. We literally draw out to the, it's a spreadsheet, but we literally draw out where we're getting the money from, so that they know that we're working in the know. They're not, hopefully they're going to be okay. I'm hoping this is going to be fine, that type of thing. Yeah. We work in the know. It drives me nuts when I hear someone say, "Oh, I think I'll be okay." Well, if you're 80 years old and you're out of money, if you think you're going to be okay and you're not, what do you do? Go back to work?
Yeah.
Or you go live with family? No one wants that.
Well, if you'd like to get that Protect and Grow plan, if you'd like to get that book income allocation, pick up the phone, give a call now. Certified financial planner Tim Stearns here as your resource, Chicagoland. 800-640-2256, 800-640-2256, making plenty of additional educational resources available to you as well. The first 10 callers with at least $500,000 saved for retirement. That book income allocation, probably a great place to get started. Today, we talked about debt, credit, budgeting, spending, income, all major factors in building our personal financial structure and confidence, having impact and implications on our financial situation that oftentimes are outside of our control, but the plan helps to identify those things. And as we've discussed today, you understand those areas, you address them, and you can gain better control over them or protect yourselves against them. And as always, that's the big offer on the program to get that Protect and Grow plan at TJ Stearns Inc. Tim Stearns, CFP, helps savers and investors better determine their outcome and turn goals into reality. So if you would like to learn how you can retire, when you can retire, how much you need to retire, how much you can generate from your retirement savings, how to be as tax efficient with it as possible, pay less in taxes, pay less in fees, all of those are covered in that Protect and Grow plan. Pick up the phone, give a call, 800-640-2256. That's 800-640-2256. And Tim, we always appreciate your time here on the show.
Peter, thanks for having me.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.